So this panel is on mid-market and growth capital. And I have the pleasure of introducing Mr. Vivek Pareek, partner, Saraf and Partners, who is going to be moderating this panel. Vivek, will you join us on stage, please? I'll make a little bit of an introduction for Vivek. With over 15 years of experience in advising corporate transactions, Vivek has an impressive track record spanning domestic and cross-border M&A, FDI, private equity, restructuring, and insolvency transactions. He has advised leading corporations and private equity funds on several marquee deals, including Viatris's divestment of its biosimilars business to Biocon Biologics, AMNS's intra-group merger and demerger valued at $7 billion, JSW Infra's acquisition of Navkar Corporation and Adani Power's acquisition of Coastal Energen. Vivek's sectoral expertise covers steel, cement, logistics, consumer, retail, media and broadcasting, healthcare and pharma, as well as construction and real estate. So welcome, Vivek, and we look forward to a very exciting panel. And I must introduce our very, very distinguished panelists today. Mr. Gaurav Chauhan, Manager, Private Markets, Mankind Pharma Family Office. Would you please join us on stage? To a big round of applause, please. A lot of things are taxed in this country, and applause is never taxed. So please, please, there has to be a bigger round of applause for all our panelists. Mr. Imran Jafar, Managing Partner, Gaja Capital. Mr. Kshitij Dodia, AVP, Stakeboat Capital. Mr. Sumit Sinha, Co-Founder and Managing Partner, Filter Capital. And last but not the least, Mr. Gaurav Sekhri, Partner, TVS Capital Funds. Over to you, Vivek.
So thank you so much, Venture Intelligence team, for giving such a long introduction, okay, and a very illustrious one at that. I mean, I was not expecting that. Traditionally, moderators, I'm aware it's a post-lunch session, and any moderator would be very tempted to take make a joke about food comas and the audience being sleepy. But I see the energy is palpable here, and everyone is like really excited. The audience is wide awake. So we'll jump straight right into the panel discussion. So today the discussion is on focus on mid-market and growth capital. It's a dynamic and evolving space. I mean, Arun has done a great job of keeping the session in between venture capital and private equity, because growth actually is a balance which is needed between the agility of VC and the discipline that private equity gives you, right? So, and who better than the exceptional individuals that we have alongside me to discuss on this topic. So let's dive in. I'll just have each one of them just briefly introduce themselves, give a self-introduction, and then we get to the discussion.
Great, thank you, Vivek. Mankind Family Office per se, it's a multi-asset, a multi-stage family office. We do everything per se, public, private, real estate. I personally look at private. So anyways, we also do multi-stage and more like a sector agnostic, and that's how I think family offices are also becoming that diversify as more as possible, and in terms of taking long-term bets and high growth kind of opportunities. So we are also doing the similar kind of a play, but more like you can say patient with a growth mindset, patient capital, but because we have a long horizon, so we do have a very good interest in terms of tech per se, that could be both in consumer tech, B2B, industrials, deep tech, or space tech. So we have taken across early, mid growth, and this is how I think sooner, what the kind of, the rise of investing, private investing we are seeing. So this is what is happening across. So we do focus on that perspective. Mid stage, we have also done a pretty active last 1 year as well. So yeah, that gives us a good comfort having, VCs, good IPO market and everything brings up a whole lot of good timing, doing it in this time than before. Yeah.
Thank you so much.
Hi everyone, good afternoon. I'm Imran from Gaja Capital. So we are a private equity firm that invests at the intersection of three things. We invest in India's mid-market at the growth stage, and increasingly in new age companies, call them tech and tech-enabled businesses. In the last 20 years, we've raised roughly $1 billion in 4 equal quadrants. So 25% in education, employment, and employability, 25% in consumer, banking and financial services, and intelligent software and automation. And some of our recent investments are Fractal Analytics, which is likely to go public soon, which is an AI services company. We invested in a branded eggs business called Eggos, which wants to be the Amul of eggs. They started out in the NCR region, but they're also available in Mumbai. And then we invested in an affordable housing platform, which is now called People Home, which used to be called Weaver Services. And we partnered with Premji Invest and Lightspeed, along with HDFC executives and a professional team to create a 2,000 crore book, which will then scale, using a tech-first, low-cost model in affordable housing finance. Very happy to be here.
So good afternoon, everyone. I present Stakeboat Capital. So at Stakeboat, we are a private equity fund, largely investing into 3 sectors which are focus for us. One is healthcare and life sciences. The second one is B2B tech and services. And the third being industrials and manufacturing. Currently investing out of a second fund, which is slightly above 1,000 crores in corpus. Idea is to sort of take significant minority positions or do buyouts within the 3 spaces. Glad to be here.
Hello, everyone. My name is Sumit. I co-lead a growth equity firm called Filter Capital. It's a firm focused on technology and technology-led companies. Now, the lines are blurring, so a lot of it in the mid-market ends up being in the space. We look at everything across software services, but also technology-led consumer, financial services, and B2B. Some of our portfolio companies include Capillary Technologies, a software company focused on loyalty, and R for Rabbit, it's a baby product company, and M1 Exchange, invoice discounting platform. So I look forward to speaking with everyone.
Hi, good afternoon. I'm Gaurav Sekhri from TVS Capital Funds. We are a private equity fund and currently started deploying from our 4th series, which is TVS Shriram Growth Fund 4, and also finishing exits from our 3rd fund. So been investors in more recently companies like Go Digit General Insurance or Leap India, historically companies like Ratnakar Bank, Nika. So from the current fund, I think focusing on financial services, insurance, technology businesses.
Well, thank you, everyone. The snapshot was really helpful. Now, just to understand a little more, it will really help the audience to understand the firm's investment DNA for each one of you, right? What would you actively seek and what would you avoid? So if each one of us, each one of you could briefly walk us through, what drives the investment decision-making process for any target. If you can throw some light on that, we can start with Gaurav Sekhri since you have the mic there.
Yeah, it may be a very long answer, but I'll just keep it on the big picture there. So one, I think we are very driven by best idea investing. So we are a private equity fund. We don't make more than 12, 15 investments per fund. So it's fairly deep underwriting, understanding the category, sector opportunity, right from the macro hypothesis to the category hypothesis to the company hypothesis underwritten. And we typically map out the entire spaces and arguably get to the best company and arguably get there first and be able to do that transaction with that founder. Second, I think we're very, very, very biased on, I think based on historical experiences, I think in our assessment, there was a majority of the value which was coming from the founder or the leadership team. So the assessment on that part is very, very critical for us. So different layers of diligences that we do and different layers of assessments that we do. And obviously to be able to work together as partners because you're there for 5 years, 10 years and all. And they obviously, while you will be their advocate, they also need to be your advocate. So you got work in that good partnership. So that assessment, a lot of time is spent there as well. And I personally spend a lot of time on exits also because I've been through many and I know how hard they are. There's no point, because ultimately from discharging a fiduciary, it's very important to give the money back to the investors and not have a long list of deals you've done, right? So I spend a lot of time on exit hypothesis underwriting as well. I make as many calls as I can. And so I think discovery, I would say, of the best idea, good partnership, a lot of time on assessment of ambition, execution, ability to attract talent for the founders, how people work together. And yeah, that's it.
So Gaurav, you made a very interesting point, how to attract talent for the founder, right? And you spoke about financial metric as well. How do you balance between the two, between a founder's vision and the financial metric of the company? How do you balance between the two? Because sometimes they may not be in the same direction.
Yeah. So our engagement starts quite early on the HR part, before the investment has happened. So, and typically that engagement on HR, with this, for example, you discover, so founder has this perspective, okay, this is typical issue that you discover is second line issues, succession issues, first line is pretty solid, there are gaps on the mid, or they don't want to spend on a CFO or don't want to spend on a CHRO, more spend on business development and stuff like that. So I think, but I think most people get it after a while. It's mostly about prioritization. So I think you generally arrive at a middle point. I mean, typical investors say that, okay, make it a condition precedent and all that stuff, right? So you find a practical middle ground, I would say, for that. And the second part, I think once you've engaged the advisors who are specializing in human resources in general, right? So they practically, on that aspect of business, continue to work with them and actually shift from us being the client to the company being the client. I've seen it in 3 occasions. So it's quite synergistic how they work with them in solving or helping them, at least enabling them. I would not say solving it, but they do enable them to fill those gaps in. And the relationship continues. And the fact that they've worked with them before the investment, it really helps build that relationship. So, but generally things fall in line. I've not had a problem, really.
Sumit.
Yeah, so we operate in a very unique space, which is kind of sitting in the middle of a barbell. We are a technology-focused growth equity firm. So there's a massive venture universe that comes before us, and a lot of money has been raised, and every week we hear of a new venture firm being launched, which is a great thing. But that also means the volume of opportunities we see is tremendous, because we come in at Series B, C stages, probably meet a company a day almost. And on the other side of the barbell is our large private equity firms who are waiting to deploy hundreds of millions of dollars, maybe billions of dollars in a year in India. So in a way, we are in a sweet spot, but that also puts a lot of onus on us to be really targeted, really focused on how we evaluate. And there are 2, 3 things we look at in particular when companies come to our stage of investing. The first one is the founder's mindset. And we see a lot of founders who are scaling really well, guided by venture capital, a lot of top-line growth, a lot of customer growth and love potentially. But we really apply a strong lens on how prudent the founder is, how strong the execution capabilities are. A lot of times when we unpeel the onion, we see that while the customers are buying, the unit economics are broken, and the product market fit may not be as strong as it appears. So that becomes an important check, and that itself is a big screen. We also look for situations where you can actually see a line of sight to a sustainable business that can scale and stand on its own feet. We want to be almost the last, if not the second last capital into the company before it lists. And that also requires a different set of analysis where you can hit a 200 crore revenue of 100 crore revenue while still loss making. Can you become a 1,000, 2,000 crore revenue business with a decent profitability? And that analysis is also very unique. And part of that analysis surfaces a lot of things, a lot of gaps in the strategy, a lot of experiments that are happening that we have to almost align with the founder on, that you probably will want to shut those down. So if I were to rename our firm from Filter Capital, you could call it Focus Capital, because we see a lot of things thrown on the chart, but very few things are working. And our job is to identify what's working and double down on them.
Thanks, Sumit.
So kind of same and probably echo what Sumit mentioned, that again from our perspective, idea is for us to be very focused. We generally want to be part of 12 to 15 companies as this fund. In terms of when we like an asset, where would we like to partner with the company is generally when there is a decent steady state of revenue visibility, and we don't invest in loss-making companies. That is one very important objective for us. Obviously, there are exceptions to it, and there could be, but largely I think the intent is to back profitable companies. And I think also when we looking to underwrite a business or an asset, it is largely about the business, whether it has the necessary tailwinds, whether as a team we have the right experience to sort of also be a part of their journey. Because as part of our sort of framework, we spend a fair amount of time with our companies in sort of building their businesses, and to the extent we could help them. So, yeah, I mean, profitable companies to some scale, that is one. From a founder's perspective, obviously, founder and management team are like the very core of any business, and I think the alignment with at least the founders and the team is their depth in the senior management. How good is the second line of command? Because ultimately, those are the folks who are going to run the business, right? So that is mission critical. Also, I think one important factor is to evaluate, because now the companies sort of, after putting in growth capital, they will be going through a tectonic shift, right? So to what extent are the founders, the management team, willing to, sort of take decisions which are sort of contrary to what they have done? That is another important piece, because if there is no flexibility, then, I mean, might as well we'll actually, whatever we tell them will not be beneficial, right? So I think, yeah, combination of all these things.
Yeah, Imran, please.
Same question. So we provide growth and buyout capital to India's mid-market, high growth companies in India's mid-market. There are two types of deals that we do. We buy significant minority stakes in high growth companies. At the growth stage, 60-70% of deals we see are typically venture backed. So in these companies, a lot of the heart of our evaluation is to assess whether they have crossed the chasm from startup to scale up, which is a combination of unit economics, maturity of the team, have they hired lateral talent, retained them, have they been able to discover adjacencies beyond the core product market fit that was the basis for their early stage funding, and so on. So these are companies like Egos, for example, which was started by two IIT founders who actually, after a couple of years of working in corporates, went to Bihar to set up a poultry farm. They actually ran a poultry farm and then decided to forward integrate into creating a brand which they're now scaling. So companies of that nature. And the second type of deals we do are management buyouts, where we're looking for experienced enterprise talent. These are seasoned business leaders with a proven track record that are looking to turn entrepreneurs. And there is a segment of the market that want to be owners as opposed to employees in large billion-dollar buyouts. And so for those individuals, we are a great fit because we help them buy companies that are, let's say, 100 crores. And then with their help, we help them scale it to 1,000 crores. So roughly speaking, in 20 years, in the 28 deals we've done, 2/3 would be the significant minority, increasingly VC-backed persona. and 1/3 would be the management buyouts.
So just to follow up on that, now, would there be any metric of sort, that would immediately disqualify a potential deal for you? That's a no-go, that you don't want to touch that, be it regulatory, be it compliance, be it governance for that matter. I mean, are there any red flags of sorts which for you would be like, this is not something we will touch?
Yeah, I mean, we're trying to get more data-driven about us, what we call internally our screen one. Because like some of my colleagues here have said, it's, you're inundated when you work in the center of, at the growth stage, you see a lot of deals. So what is our screen one? I'll tell you our biases. So and please, and for the audience, the biases are less about, it's more about segmenting the market because you can't do everything. So one bias we have is we like to back professional entrepreneurs. Professionally qualified, professionally experienced, first-generation entrepreneurs, as opposed to families, conglomerates. That's a very strong bias, right? Because we feel that we can work better with them, and also we are far more aligned with them because they don't think multi-generation. They think in timelines that work for us. The second bias we have is on companies that have to demonstrate evidence that they are scale-ups as opposed to startups. And I shared some of this qualitatively, and it varies by sector. For example, if you're a SaaS company, we were early investors in SaaS. In fact, Kshitij, in your portfolio, Lead Squared, right? Chandra did Lead Squared. He was one of the early investors there. We came in 2020. At that time, the big question in the VC community about SaaS was, is there even a TAM in India? So everyone was investing in SaaS companies with US in mind. We took, at that time, a contrarian view, which is now mainstream, which is India TAM is $1 billion+, and we'll get there, and Indian companies will consume SaaS. And so we invested in Lead Squared. So we're looking for niches within sectors where we operate, where those niches can turn mainstream. And on the back of that, then you're looking for unit economics. And SaaS, for example, the net revenue retention is a very important metric. The rule of 40 is a very good proxy of sustainable growth, the magic number, and so on. So there's a whole host of bespoke metrics to assess whether a company has crossed the chasm from startup to scale up. In consumer, if you're a D2C brand, for instance, your ROAS becomes very important. But equally important is your channel mix. Also the number of SKUs you have, how diversified is your revenue base, and how sustainable is it, how large is the TAM, and so on.
And when you say channel mix, it would be how much is QCOM, how much is your wholesale channel partners that you have.
Exactly, because we all know that if you're a brand born in quick commerce, it's fantastic. So is Eggos, by the way. But then if you don't crack other channels, you're not going to be the Amul of eggs.
Absolutely.
So, then what is the assessment of, how much capital will it take, and the capability you need to build, and the mindset of the founders, and so on.
Thank you so much, Imran. Very helpful. Coming to Gaurav Chauhan, I mean, you wear both the hats, right? You invest in funds and you do direct investments. So what would be your decision-making process? Like, how do you make a decision as to this is where I want to go?
So I think it's both, pretty easy and difficult when you do that, right? Being on a multi-asset side. But anyways, when you are looking at the private, anyways, the benchmark comes from the VC industry per se, right? And that's why I think we have also, taken a good exposure towards direct and indirect both. And this is how I think a lot of learning, I think the last cycle of investing through VCP investing, we have seen that, okay, what works in India, what doesn't, right? So anyways, we have taken a lot of direct exposure as well. So more or less, if I tell you VC investing framework, we also use the same way, right? The professional management team and everything. But from the family office, I mean to give you a little bit deeper view in how family offices think is, because anyways, the exit timelines are longer, right? So we haven't taken any exit yet, but we think it in a way that if it can compound, it's great, right? I think if it goes to IPO, we can still be there. So from that perspective, we see that the business which is solving something big and which can become great, right? So companies such as, and we are also very big believers in India, we build our business from the India itself. So we see that Indian founders building out of India and building for the world, there has to be a very strong problem solution fit. So, and one of the learning I think which comes from building the business yourself is that you don't look at, the kind of very short term kind of a plays or, fluff kind of a things. You just like, okay, this makes sense, this doesn't. You're easy to call out and you can say that, okay, this is our comfort is, and this is what we look at, in the long term per se. So it just becomes it has to fill that test, firstly, very strong problem solution fit. The team which is gonna, deliver it, or at least they should be having at least 5-7 years in mind. Otherwise, they can't build it, right? So from that perspective, anyways, the acquisition kind of a plays go out of our investing, right? So if you're building for acquisition, we don't think that, okay, that you can build that or have that kind of a mindset. So until unless you're building for the long term, we are, we are there. And then the opportunity to go global with, the IPO kind of a play, that can be the best strategy for us, right? We have like all sorts of unlisted plays of your NSE and everybody. So, and anyways, while we play multi-stage, so anyways, you have to take risk as well while you are investing in private. Anyway, so we go very early as well, and when there are no, you can say, when you mentioned the profitability or this. So sometimes we also invest pre-revenue or the pre-market as well. But then yes, that is just you can say the call on the kind of problem they're willing to solve, or a little bit of whatever MVP there is, or the founders, thought process, what they're doing. Mid-stage, we just look at, okay, if they're at a very good growth trajectory, having a good market share or a growing market share coming up with. At a late stage, you can say we are more like, okay, if they have established, everything is there, and you can get a good, piece of the business. We largely take, you can say, at the early stage, we are good with minority kind of a stakes per se, and we stay long in the business, keep on investing as we see that, okay, this is meeting certain milestones or the satisfactory growth happening in the business, so we keep on doubling down in them. So that is on the direct side, and indirect side anyways, because majority of our exposure is in tech, so we do the same view over there as well, multi-stage, early mid-growth, but largely tech focused, and betting for the long-term growth in India, who are, filling up different sectors, like now AI infra is there, energy is there, right? So I think identifying that early on, so this is what we like to do, keep on studying that, and a lot of it comes from, the VC industry itself. So we keep on looking at, what the people are doing, how, we see. So anyways, the similar thought process, and roughly the process comes in, through the internal team research. So we go out, so it's not like that, we'll be waiting for an opportunity. We also go out and look at what kind of companies we would be looking. So I think quantum and AI is coming up like a very, very common these days. So what makes sense in both these two domains, we'll go out and look at them and, come in very early as well, not wait for this. So yeah, we also do that. And this is how our process looks like. EdTech, HR tech, we have done, but we have also burned our hands. So for us, we just feel like, okay, very little you can do over there. Like you said, the small time, then it grows after a lot of efforts. So we see like unless there is a big push coming in from the market side itself, a good problem you're solving, it automatically picks up. When you say the industry tailwinds and everything, so it automatically comes up.
See, we are in very interesting times, right, with the geopolitical situation where it is. And you used the phrase built out of India, built in India, and built for the world. So would you look at it by saying built out of India, for India, scaled in India, and then built for the world, or just built in India and built for the world?
No, I think it's both, because, so again, our first thing would be what you are solving. Right, solving for could be India or for the world. That could be anything. So I mean the great examples and the great stories that we say, right? So Miko is a portfolio company. So Miko is they sell toys, right? It's a walking Alexa for kids that we say, and kind of a hardware product, which tried it out like very, or the initial positioning was very different, but built out of India, selling for the world, because majority of the market is in US. Hardly anybody buys that in India. But yes, we help them in terms of cracking the code in terms of, because they were selling $200 toy. But yes, we said, who's going to buy $200 toy? Make it 100. They did 100 and they got a lot of orders. Your, Thanksgiving, Christmas gifts and everything in US. lot of, like, they piled up a lot of orders. And based on that, now they come and say that we want to do $50 toy now. So basically all those insights and all those things, so it could be anything. Build out of India, it's fine, because we are largely focused on India, for Indian founders building for the world, or scale in India, build for the world. We are there, so it's not a problem there.
Right. So, see, next question for Sumit and Imran both, because you both mentioned that, Sumit mentioned we would come in, let's say, at a Series B or a Series C. And Imran, you said you would typically look at companies which are already VC backed, right? So when you already have VC sitting on the cap table, are there any alignment issues on governance that you face? And the other question would be, the founder at a Series C round, there is a possibility that they're sub 10%, right? So does that bother you, or how do you incentivize the founder in such cases, if you could throw some light on that?
Should I start?
Yeah, go ahead.
Yeah, actually, it's a very good question in the sense that so far, in most of our investing, we used to be the largest shareholder and the only institutional investor on the cap table. And then that started changing around 2015-16, where there are a few companies now where, we have a lot of VCs on the cap table. And so it's very interesting that our evaluation has one other dimension of evaluating the VC partners that we would like to be in the company of. And this is a completely new set of evaluation. We see it exactly that way. So there are certain VCs we trust, and that then adds to the underwriting and the business case and the comfort. So the investments that we've made and the VC partners that we have on the cap table, we've drawn a lot of comfort from. Also, the folks that we buy from. I spoke about Stakeboat Capital in Lead Squared. We were very comfortable with Chandra, and that was an important part of us investing in Lead Squared. But also, we're partners with Stellaris, Arkham, Vertex in Scienzy. In Egos, we have IVCap. So, these are partners that are increasingly, if I look at our investing over the next decade, it's going to be a very important part of not just the ecosystem, but our comfort. Now, coming to founder stakes, we obviously would prefer founders having skin in the game. In the odd case where you find founders that have diluted substantially, we try to address that by creating incentives that are either exit linked or value creation linked or scale up linked. Because in most of the cases where founders have diluted a lot, it ends up being a company that was started ahead of its time and has pivoted once or twice before they come to us. And in that case, you have no choice but to give the entire team almost a fresh start. So we do that.
Your thoughts, Sumit? Your thoughts?
Yeah, I think, we've been working with VC ecosystem for almost 15 years. And prior to Filter Capital, I spent a bunch of years at Warburg Pincus and then with Multiples. And we were one of the early investors in the growth equity ecosystem in tech. This goes back to 2010, 11 times. And I remember the cap table of Quicker, where there were like 7 VCs, everyone you can imagine at that time. There always pushes and pulls, and it happens more often when the firm is not doing well. When the firm is doing well, everybody is happy, nobody has any conflict. So we learned a lot from those experiences, and I would say the first and most important criteria is to make sure there's alignment. Alignment both in terms of strategy, in terms of how they want to navigate the company from here for the next 5 to 10 years, but also equally important alignment in terms of exit. We do see sometimes the terms in the agreement are such, or the understanding the founder has VCs is such that they want an exit in the next 2 years, for example. And that's a red flag. We have to make sure that cannot happen off the bat, and we have to renegotiate, or we have to align, or we just give up on that deal. So that is critical. But as Imran said, it's a lot about quality VCs you work with, and if you trust them, then they'll do the right thing for the company. Because we have to understand as investors, we have a dual role. We have a duty towards our investors, but an equal amount of duty to our companies, because we are sitting on the board of those companies.
See, you hit the nail on the head. There are VCs already on the cap table who may have fund life or may have commitments to return that capital, right? You are coming in at at a much later stage, right? Where you want to be in the company. So what do you do with those company-led exits? Like, would you realign those exit horizons for all? Would you have tighter governance rights for yourself? Or I mean,
Yeah, we can't say we are unilaterally having certain rights. We have to be pari passu with everyone, but we do realign the exit timelines. We can't have a wrinkle in the middle where in 3 years there's some kind of drag right sitting on the on the SHA, which you can't deal with. And you can say, I won't be dragged, but who's going to sit on the cap table alongside a strategic when everybody else exits? That doesn't work either. And what was the second part of your question?
Incentivizing the promoter, because they would
that's
by
actually
then,
it's a massive red flag. And as Imran was charitable in saying that in some cases founders are owning only 10%, it's probably because they're in multiple pivots. But I think we do see it as a red flag. We've been fortunate that in many cases when we've entered, the founding team at least owned a good chunk, because we're coming at Series C. It's not Series D or E. So by then, if the founders have diluted so much, then it's a sign that the founders haven't executed so well. So we have to make sure that often we pass on those deals actually.
all right. So for you, you would need the founder to have, substantial skin in the game. It cannot be a sub 10% situation that would make you uncomfortable, right? So coming to you, Kshitij, right? What are the recent, key trends, sector priorities that you're witnessing? You are a sector agnostic fund, right? You've invested in healthcare, you've done financial services, and you've done consumer as well, right? No, not yet. IT, ITES, tech you've done. So these are the four, I would say, usual suspects that all private equity would be looking at, because that's something which is given capital back. So what are the key trends that you're looking at?
So again, I think personally I spend a lot of time doing healthcare investments, and I have a healthcare investing background prior to being a part of Stakeboat. So I think what COVID has actually taught us that, people are now willing to pay a certain amount for healthcare, and therefore you see this certain boom in the market, right? Listed space, unlisted space, the large global private equity players coming into the fray now. So I think, let's say within healthcare, right? As the stage we are in, we sort of like single specialty in healthcare delivery services. So we like single specialty hospitals. I think in our current portfolio, we have a company called Sukino Healthcare, right? Which is right now one of the largest in continuum care, rehab care for, let's say, stroke patient, cardiac arrest patients. Right?
That's like more of a post-surgery care,
It
right?
is most post-surgery, but not in-home. So there are like proper centers, sort of try and replicate the hospital model. So you'll have like a proper room there, beds, everything there, right? So, that has panned out really well. In fact, when we invested in the company, from that perspective, the environment was such that only home care companies were prevalent, and people were not willing to pay a certain price of it. I think what we have done in collaboration with the medical fraternity, with the clinicians, etc., we've been now sort of been able to charge a very decent price from patients, as well as providing the highest level of care. So much so that, in our, let's say, the forte, the region, Bangalore, where the company is situated, almost all the neurologists or neurosurgeons would sort of refer their patients post-surgery there. So I think single specialty is very, very key theme. And personally, I think within single specialty also, let's say, pediatrics, nephrology, urology, obstetrics, gynec, I think very emerging themes. And there is still a lot to be done there, while so many investments have happened. Within healthcare, again on the pharma side, on the life sciences side, we feel that the contract manufacturing is again one segment which is going to see a lot more traction. There are obviously, it's a more cyclical business to some extent, but the way things are now pivoting, and hopefully China plus one is not actually like a phrase, it sort of turns more towards India. So feel contract manufacturing within the pharma life sciences space is also one key area. Let's say moving on to manufacturing and industrials, which is the second key theme for us. We are seeing a lot of companies in precision engineering for aerospace, defense sort of projects. these are specialized players. I mean, there are a lot of capacities which are already there in China. Again, this is more on the China plus one theme. And there seems to be a shift from China towards India. Good part about these businesses are highly specialized. There are long-term contracts. So from a stability point of view, from an investment point of view, it makes a lot of sense from a growth standpoint. Let's say within tech, right? Right now, we are investors in an IT services company which is focused on mobility as a theme, which includes automotive and manufacturing divisions. So we serve one of the largest OEMs globally through that company, and it's a buyout transaction for us. So within that, we are trying to pivot into manufacturing, customers. So again, I mean, these are the broad three themes that we operate in. What else? Yeah, I think that's good.
So to you, Gaurav, Sekhri. Now, how do you evaluate the situation of a tech versus a non-tech in the current environment, right? There's a lot of buzz around deep tech, emerging tech, AI, right? And if you look at the data, last year, again, ITES have been the highest numbers achieving sector in India. Do you see the trend continuing, or you would see renewed interest in manufacturing with the push that we have for Make in India and with the recent tariff situation that has happened with the US?
See, if you take a view as, see which are the important pillars which are going to drive the India's GDP growth, right? All of these are true, whether it's manufacturing, whether you layer localization or you layer independence, self-reliance rather. Tech has, I mean, it's integral to India in the sense whether you look at the quality manpower numbers, capabilities, education institutions, focus and stuff like that. So India opportunity is unique that I think it has been both areas, I would say, and it continues to be both areas. And at least we are seeing both traditional areas in financial services and tech standalone, as well as I think opportunities which are like I think some of the niches that were mentioned earlier. Of course, I think with AI, probably the amount of money which is going in that areas, again, there are three areas there in the sense, of course, one can argue that what do you find in the infrastructure space in AI in India? It's practically not there, but it's a little early stage. At least we are not immediately looking at those areas, but we started looking at those areas right now. I'll tell you what, I think what we are seeing as opportunities, whether it's particularly on the traditional side or pure tech side, right? What we've experienced in the past that we've been typically coming at, say, Series C level or sometimes Series C and selectively Series B and all. And probably I'll share a few examples as well there. Like I was an investor in a company called Cottage General Insurance. So there, and even if I take an example of a Nika kind of, which is a tradition, I mean, you can say that it's a vertical commerce player at that time. So if you look at the track record of those founders, right, absolutely brilliant. Even if you think that you're doing a Series A, but when you actually work with them, it absolutely doesn't feel like you're working with somebody at Series A level because they've been sort of veterans in that space. They built massive businesses in those areas there. So that I feel is a great opportunity whether you look at from a tech perspective or non-tech perspective. For example, we're seeing that fantastically, like I think Imran mentioned in terms of professionals, right? If you look at their execution track record, they obviously reached a certain stage in their career. They've been CEOs, CXOs and all, but there are tremendous capabilities to build those traditional and non-traditional tech businesses right from scratch. So hardly feels like you're coming at even a first check, so to speak, even if you put a first check. The benefit is that it really multiplies your return beautifully. But obviously, I think currently for us, if I look at financial service and technology, obviously there is more probably opportunity coming on the technology side. Um, Financial services slightly more challenging, I would say. So there is obviously a lot of money chasing. So maybe like Weaver was a platform, I think Imran mentioned. So those are, I mean, those sort of opportunities are probably those which can probably absorb that kind of capital which is chasing financial services. But I think future probably looks for tech, I think.
So quickly coming to that, you have a lot of exposure in financial services. You have portfolio companies which are there in the financial services sector.
Yes.
Are you suggesting, I mean, the sheen has reduced and you would be, or rather the market is looking at other sectors at this moment, or financial services? Because after IT, ITES, as per data, financial services is the second sector which has attracted most amount of investment. So with the regulatory oversight and, you know, some tightening by the RBI for the fintechs, would you look at other asset models in financial services, or do you see a continued growth for NBFCs in financial services as well?
See, this talk about NBFCs has been there for 20 years. You look at 15-year-old articles or 20-year articles. This all goes in cycles for 5 years. But at the big picture level, the opportunity is obviously very, very big. You cannot have that penetration of capital without NBFCs, at least for now. Of course, different models in that, you got to be a little more cautious. And from what we've seen in cycles, like what we've seen in MFI in particular, right? And we were investors in Suryodaya also, at Suryodaya Small Finance Bank at some point of time. There are times you make money, times you not. Beyond the, I would say, what at least I have seen opportunities is that beyond the typical NBFCs and all, like if you really map out those value chains very, very clearly, you know where the profit pools are sitting, revenue pools are sitting and all. So there, at least, if you track that pretty closely, there I see very interesting opportunities coming up. For example, I'll take probably 2 examples. There was a time where you may not have consolidation opportunities in the insurance broking space. Similarly, if I look at tertiary care or single specialty, single specialty has been a brilliant area, even if you look at 2015's, whether it's single specialty eye care or neurology has just sort of, nephrology picked up a little later, but something like eye care has been a brilliant opportunity earlier as well. Similarly, so there are timings, at least when I think the time is ripe for making big opportunity. For example, like something like a Weaver is probably seemed like a pretty interesting opportunity to build a platform. Similarly, you can find something in which people have already started, like a corporate insurance broking space. If you see, there are probably 600, 700 brokers in India, right? They've reached a certain scale. Similarly, one could see that in institutional food services also. So I think it's just a matter of, you know, for me it is timing. It should be the right time to do that. But I've not really found dearth of opportunities, really.
No, understood. I mean, given that the sector remains systemically very, very important for the economy, so I think the consensus is that it will continue to see growth. So, Imran, coming to you. Now, your thoughts on tech versus non-tech. I mean, your last 3 investment, one you just mentioned, Egos, is a consumer company, which is again dependent on the channel that it has, and it has an element of tech being QCOM if you combine with it, right? Then there's one analytics company that you just invested in. So you are completely sector agnostic. That's what, I mean, the recent trends of your investments have shown. So do you see tech versus non-tech? Are you seeing manufacturing getting more prominence, or do you believe it'll be a mix, or tech will stand out? As in, what are your thoughts on that?
Yeah, so, you know, we've been saying this for a while, even before AI, that technology has to be seen as a horizontal in our investing. So if you look at our portfolio over the next decade, you'll see tech has to be should have a permanent presence in every investment we make as a significant value creation driver. So that's kind of a constant now. Now it's only about us figuring out, is it AI, is it something else, right? Which comes along. And, you know, they have their own hype cycles. But can you actually do anything today without understanding tech and applying tech? I don't think so. So that's clear. Now, from a capital allocation point of view, there are some, like for example, 25% of our capital allocation is in intelligent software and automation. We just signed up recently with the Indian Deep Tech Alliance. Some of us were talking about it before the panel, and that's an example. So we've started now covering deep tech companies far more actively than we did earlier, because a lot of those companies now, we see companies that have been in business for 10 years, 8 years, 12 years, doing very interesting things in deep tech that are now reaching the Series B stage. Some of them actually even at the Series C stage. And so we, over the next decade, you'll see us allocating capital to those companies. Intelligent software, I mean, we used to call it software, and we added intelligent software to it because of applied AI. And Fractal Analytics is an example. Not everything that they do is intelligent software. They do data engineering work, but there's a meaningful part of their work that is intelligent software, which is getting a huge tailwind because of what's happening around the world in AI. So the short answer is we see it as a horizontal, but 25% of our allocation will go to pure software businesses, intelligent software and automation investments.
So tech remains a constant across, but 25% would be allocated towards emerging, deep, or advanced tech is what they say.
Exactly.
Sumit, your thoughts? You are a tech-focused fund, so it will be very interesting to have what you feel.
Yeah, and as Imran said, we are tech-focused, but that tech is spanning every sector. But what we do spend all our time thinking about is the company we're looking to invest in, how is it using technology to differentiate? And you will find in every industry, some companies are early adopters, more mature in their technology than others. And we believe that creates that alpha, that creates the ability to win that market, and we focus a lot on that. And our portfolio, for example, we have 6 companies now. 3 of them are software companies, but the other 3 are technology-led companies. One is in logistics, the other one is in consumer, third one is in financial services. So you're right, while we are a tech-led firm, we also, like Gaja, would probably, in our case, 40% pure tech, 60% tech-led. But we do see a lot of companies who have no technology angle to it. And we don't focus on them because we don't think they may win, but we may not be the right set of capital for them.
So for you, R for Rabbit would be tech-led?
Yes, it's an online consumer brand. It couldn't have existed without technology. I mean, given the constraints of real estate in India and the lack of growth in organized offline retail, you can't imagine having large baby product shops like you see in the US and in China. So the only way to sell a stroller effectively in India is online at scale.
Very interesting. See, the next point that I want to cover, and it's for all of you, I mean, anybody can just pick up the mic and throw some light, is competing with the IPO market. At the stage that you come in, and our public markets have been really buoyant and buzzing with deals for the last 2 years. And I was just reading this morning that in the first 9 months of this financial year, we've had 80 main board IPOs, right? And the kind of capital available in the public market, do you feel pressure, or do you feel there's competition for you to deploy capital as a growth stage or mid-market fund?
I think that's a very pertinent question, Vivek. So that's what sort of keeps us awake. I think, see, you have to appreciate, right? There is cyclicity to everything, right? This cannot go for all the time, right?
The pipeline looks very solid. Huh?
It does, and I mean, I'm not hoping that market not to be buoyant, right? Because we also need to exit. So from an exit point of view, obviously, I need the support of the markets. But I think, in purely in terms of valuation, I think to be very frank, I don't think as a private equity investor we can compete with the kind of numbers that the companies or the assets are getting in the public market. I think that's a very difficult part. I think what at least I have seen and we as a fund have seen is, I think 2024 was a lot in terms of people or assets going, even converting to a public limited company sort of a status, looking to go for SME IPOs, main board IPOs. I mean, not all have done that, not all have proceeded with it, and some are actually now coming back. I think somebody mentioned in the morning, discussion that it is quarter se quarter tak, right? So, I mean, right, once you get listed, then, I mean, quarterly pressures are for real, right? So people are realizing that there is a merit in staying private till a certain level. The headache of all the compliances, etc., are actually, from a business perspective, could be detrimental, especially if you're a small business. If you build a team large to take care of all the compliances, I think your economics may not play out in a very sweet manner. So I think we are trying to sort of maintain our valuation discipline. Obviously, there are asks on the valuation standpoint as competing against the IPOs are still on a higher side. I think twofold approaches potentially from our side is, one is obviously in terms of the potential companies that are looking to raise capital. I mean, we are trying to differentiate from a sector knowledge point of view. It's a very loosely used word, but value add, right? What can you potentially do for those companies? The second part obviously is when the valuation expectations are very high, then obviously we need to enter into certain structures in terms of their growth potential, etc., which is essentially, we also talk about it, exit linked incentives for the team, right? Because if they have such conviction and the promoter is willing to underwrite, or a founder or a management team is willing to underwrite to that level of growth, I mean, we just need to be sort of certain to back them.
Shall I?
Yeah, sure.
Yeah, I think, see, do we compete with IPO markets on deals? Yes. But has that changed? I mean, in 20 years, I can't think of a single vintage. Maybe 2020 comes close, and maybe 8 months after the Lehman crisis is the only two periods of time I remember when competition was not a problem. Because either you're competing with IPO markets, or you're competing with hedge funds, or you're competing with the soft banks and the tigers of the world. It depends. So every vintage has a certain type of competitor, which varies every 2-3 years. And you have to find a way to do deals despite that. Secondly, on valuations, if that was the implied question, see, India, you talk to Chinese investors and American investors and European investors, and for 20 years I've been hearing LPs say India is very expensive. But yeah, well, you deal with it, okay? Because you have to still find a way to make money, and yes, it's expensive because good assets are scarce. And so our job here is to kind of cut through the clutter and find those assets that have that scarcity premium and run with it. But I wanted to make share another perspective, which is, when IPO markets, valuations, these are essentially present values of expectations in the future, right? That's all it is. And so what it does is it shows founders, management teams, investors the prize money. And that creates a virtuous cycle if done well. Everyone gets energized. You talk to founders today that are, let's say, a consumer company at 250 crores, 300 crores in revenue. I mean, they can start drawing a line to a plausible IPO. But more importantly, because IPO markets ultimately don't care about vanity metrics, they're able to see, okay, if I'm at a scale of 700-800 crores, and if I squeeze out this gross margin and this EBITDA and this earning per share and this return on capital employed, then this is my prize money. And that's a very energizing, positive thing. And actually, it helps private investors like us. A lot of our conversations are about, yes, your ask is this, but by the way, this is what it will be when rubber hits the road 3 years down the line. And so it's not all bad. I think it's very positive.
So, Imran, this question comes from I'd like to give out a small anecdote that, about a discussion that I had with one of the founders, right? They just raised a Series C, right? And I just asked them that, when are you looking for your next round? And the answer was, we would wait and we would like to go public now. Is it that the founders are thinking that, let me retain my holding and not dilute further, and hit public markets if I have to instead of... So is that posing a challenge for growth capital funds, to find a deal? Because founders with the 2-year bull run that we've seen in the last 2 years, which at least I haven't seen in my professional career, is that posing a challenge? That mindset of the founder that, let me not dilute further and let's hit the public
No,
market.
that's a very positive thing. They should be dilution conscious. If they are smart founders running good businesses, every percentage of that cap table should be treated as very valuable, right? So I think that's first of all a positive sign. Secondly, we come in at Series B, Series C stages, so we're not affected by it. In fact, a lot of and it varies by sector, but in most of the deals that we do, we are the last institutional check before they can be either M&A ready or IPO ready. And so that's our expectation, in fact, that at the Series C stage, you grow up and then you start drawing a line 3 years out, can you be IPO ready? 4 years out, can you be IPO ready? So I see that as a positive sign, yeah.
Excellent, excellent. Anybody else on this?
And also to add to that question that, it is also about the funds if they want to take exit or willing to go exit via IPO, right? After a certain amount of time, you don't have much private capital available as well. So that, because India is not US, right? That you have, that kind of a capital availability. So I think that is good. Price discovery, happens through the IPO market, so which is good. So yeah, I think so. That to question to that answer to that, it is good that we have this kind of an active IPO market. But yes, at the same time, the kind of valuations. So yeah, anyways, you will buy whatever price you want to buy, right? Whatever you're going to buy in terms of anything, right? Which justifies. So ultimately, it depends on that.
Thanks a lot. Thanks a lot for your perspective, Gaurav. Now that I have you, I have one more question from an LP perspective. How are you looking at specialized versus diversified strategies? Would LPs are more willing to bet on, thematic funds, or are they still looking at generalist strategies which are sector agnostic like?
So as far as how we think is, ultimately it is a specialist kind of a approach has worked better for us. Because ultimately what happens that generalized approach in terms of this, that's more like anyways the VC portfolio building, and that's a power law that's anyways going to come. But yes, if you're looking from any particular sector per se, so anyways, okay, so in terms of tech focus, how you want to play with the tech, or what kind of problems or what kind of deployment with the founders you want to do or the focus you want to do. So we go in that detail, right? Otherwise, a generalist fund, we have seen the least kind of a, in terms of, upsides coming in. Otherwise, it's like everywhere. We have a fund which is in financial kind of intermediaries, which has all the financial winners, which has gone up great. Like majority of the IPO folks are also there. So I think specialist is something which, as far as we go, we look at.
So you prefer more, specialized funds instead
Specialized
of
funds,
sector agnostic funds?
Yeah. Otherwise, you can do across multiple specialized, right? If you want to have some other, focus or diversify into that. So that way.
Right. Sumit, Sinha, your thoughts. Are the markets mature now at the mid-market growth capital level where, you have a space for specialized focused funds instead of sector agnostic fund? Because you are one who call yourself a tech-focused, tech-led fund.
Yeah, we are a sector agnostic tech fund, whatever that means. So very deep specialization, I believe, is not easy at the growth stages. In venture, you could do that because, you can pick a theme or two and go really deep, and they'll have thousands of companies to choose from, and hopefully they'll back 25 and 1 or 2 of them really do well. In growth, at least in India, we think the depth is not there in the market to be focused on just one sector. If you want to scale the platform, if you want to raise a $100 million fund or a $50 million fund, that's different. But if you want to continue to scale the platform, you need to look at multiple sectors. So yeah, my submission would be that it's probably early.
Because it can be risky as well. You need to, diversify your risk.
You have to invest, right?
Yeah.
If I had raised a software-focused fund, it would have been easier to raise back in the days.
Yeah.
Because software was on a tear. This is 2021, 22 when we were in the market. And I can tell you, we'd be licking our wounds right now if we had done only software, that too in that vintage. So you become victim of the vintage if you specialize too much.
So while I have a couple of more questions, I want to just open the floor for any questions from the audience for all the guests here. If you have a general question pointed to anyone, you can say that, or if you want to, specifically ask one of our panelists, and please name them and point your question. Yes, lady here, please.
It's a question in general on the AI services. Maybe a macroeconomic preview of what are the main factors that are driving the investments in the AI services division. What are the investors looking at, and what is the size of an average AI company that is coming up?
Yeah, we just invested in a company called Fractal Analytics. It's a 25-year-old business that specializes in advanced data analytics, and they've built deep capability in data engineering and AI services. As you might know, there is I used to work in Wipro in 1997. So back in the day, Wipro, Infosys, TCS, that entire IT services industry does their typical deal sizes run into hundreds of millions of dollars, and they these are FTE heavy projects that run multi-year. AI services tend to be much more specialized. These typically are projects ranging from $1 million at the lower end to maybe 20, 30, in the tens of millions of dollars. So these don't tend to be hundreds of millions of dollars. And they often start with data engineering because that's the first step of any AI transformation project. And then a lot of the AI services companies like Fractal Analytics have created, automations, let's call it productized services as part of their proposition that can accelerate AI transformation. So I don't know if I answered your question specifically, but this is roughly the difference between the two worlds.
I can just add to that. My prior firm had an opportunity to invest in one of the earlier AI services companies called Quantify. It had partnered with Google and really helped build the Google machine learning ecosystem. And back then, 2019, they were doing neural network or deep learning based AI solutions. I believe AI will rewrite the entire IT services industry over the next 20 years. It won't happen in 5 years. It'll happen in 20, 25 years. I say that because the traditional IT services industry was built on legacy systems, built on rule-based processes, and built on the back of large manpower-based services companies. AI is disrupting the entire thing. It doesn't require that many people to build code. It doesn't require that many people to maintain code. And AI is now going to the next level and actually modernizing old systems into more modern systems. So as Imran mentioned, the likes of TCS, Infosys are sitting on hundreds of thousands of people who are getting billed every day. And they are not in a position to disrupt themselves, because if they do, they will start shrinking. You're already seeing a bit of that happening. So the opportunity is for likes of Fractals and Quantify to actually start literally nibbling on the edges and then gradually go for the kill. So the next $100 billion company that will come out of India will be led by AI and not the traditional technologies.
To the gentleman here, please.
In this session, I heard the word strategy on a regular basis, and that's very interesting. From a company which is just moving from venture capital to US space, the premise is the management aligning to your strategy, you are aligning to their strategy, and both are converging to a strategy. And that's very critical here. And if there is a convergence, it should be with conviction. Now, invariably, there are studies that are going around wherein whenever the strategies are enforced, because the alignments in terms of your thought process is on exit, whereas the management's thought process is on legacy. So philosophically, there's a difference. While the value creation is there, the legacy versus exit directions will be different. So your experiences in how many times it has taken the third route, which is basically coming to a mutual consensus approach, or you aligning to their strategy or they aligning to your strategy among you?
Should I start with that? If you replace the word strategy with choice, it starts becoming more relatable, if I may. So, because strategy is choice. Now, your question is, do you
choose a path that is aligned to what the management team is telling you as an investor, or do you drive consensus? Is that your question?
Yeah, see, essentially what happens is there's nothing wrong or right in this. What happens is initially venture capital, when they back on an idea, thought process, execution, so on and so forth. But by the time they come to you, and this is where it's a critical capital, and here they are not trying to be at the early stage, they are trying to grow now at a particular space. Here, every management comes with a particular idea, thought, and their eventual destination could be a legacy with value creation. Your destination is exit in certain time period. And the way you want to grow, and I'm not saying, it's just an example I'm giving it, by Juice probably. It had grown too fast in terms of acquisitions continuously in the space with a different capital, and eventually it ended up somewhere, and we could see a lot of other issues. So when you at this space comes in, the choices that management make, inorganic growth, top line growth, across continents, diversification. So these are very delicate ones. And we don't even know whether the management has capability to those strategies, even though that's a good value creation opportunities, but the existing management may not have that capabilities to leverage on those strategies. So that's why I asked this question. You aligning to them, they aligning to you, or it's a convergence?
So I'll share the truth. The truth is that there is no way investors, no matter how sophisticated or persuasive, can convince a founder or management team to change strategy because it suits you. And in a fundraising environment, management teams will rarely say no. So we spend a lot of our time being very clear on what is our investment thesis, what are the choices we want to make, and we are looking for partners who are already thinking along those lines. And if we feel in the process that they are misaligned, we don't waste time trying to persuade them to our way of thinking. We just walk away.
Yeah, I mean, often it's not about misalignment, if an entrepreneur says he wants to leave a legacy, that's music to my ears. Actually, we don't partner with entrepreneurs who have a 4 or 5 year timeline to sell. That's not our style of investing. We've made the most amount of money from entrepreneurs who continue to scale their business for a decade plus, and we just come in and out and multiple people make money and move on, right? So it's about alignment in terms of strategy is important, and blitzscaling and throwing money and acquiring companies left, right, and center is not the right strategy to build a legacy, right? So we have to explain to them what is building a legacy and what does it need to build a legacy. And if you have alignment on that, then we are totally in sync.
Hi, my turn? Yeah, hi, Shishir here. Just a quick question to all of you. Just a rapid fire. If you all can mention one fund whose thesis or performance you really look up to or awed by, other than your own fund. That'll be great to know just one fund name from each one of you and why. And one more thing for you, Imran. Congrats on your upcoming issue. And if you can share key motivations behind your IPO, that'll be inspiring for all of us as well. Thank you.
Thank you. We look up to many around the world, but GTCR, which is a very prominent, hands-on private equity firm in the US, it comes up a lot in our aspirational, discussions. And thank you for mentioning the IPO. We've got SEBI approval, which is all I can share because that's in the public domain. And we like to think of ourselves as India's first independent and institutionalized private equity firm. And that's been the driving force and the vision behind Gaja Capital. And hopefully this listing will further that vision.
I can go next. We admire a firm called Insight Partners based in New York. They actually literally created this category of venture growth, or the cusp between venture and private equity way back 10, 15, 20 years ago when they were set up. And they've found some phenomenal success over time and raised a lot of capital. But what they've also built as part of their franchise is a massive portfolio support ecosystem. They have almost 200 people who work full-time to just help their portfolio companies. At that scale, if you can create value, then you're unbeatable. And we aspire to be that, but it'll take us a couple of decades.
So we do admire this US-based buyout fund called the Riverside Company. It's a $18 billion fund, largely investing in the same spaces as we do here. I think one of the very critical points just Sumit was referring was portfolio management from their end, right? I think in terms of an asset when they are building and they are a buyout fund, right? So the kind of aggression with which they do bolt-on acquisitions, which eventually adds on to the value of the asset, I think that's phenomenal. Yeah.
I'm not supposed to have favorites, but anyways, we learn from everybody. So the world is open, I think. So we keep on, looking at each and every, and we have majority of our investments are also co-investments. So I think everybody or we admire or work with everybody. So can't say anybody's or somebody's favorite, but yeah, learn from every. I think a lot of co-investments are also with the portfolio as well. So great to learn from, the ecosystem per se.
I think I enjoy the work of A16 because whatever I read of them and whatever I see of them, right, I think they pick up and seem to be seeing ahead, right? And to do that quite consistently probably reflects a certain mindset. So I think that is one I really like.
Excellent. Gaurav Chauhan has taken the easy route. Being the LP has not taken a single name, right? That was expected. Okay. Now, quickly, Kshitij, you mentioned the buyout fund that you take inspiration from, and my next question is actually on that. I mean, do you see buyout opportunities in mid-market? And which sector, seem ripe for a mid-market buyout in the current trends that you see?
So I think, as I mentioned, one of the key theses for us is to do buyouts, right? We've already done one, and it's obviously not easy, right? So comes with fair amount of challenges on its own. But I think what we feel as a fundamental shift is like eventually the family-owned businesses, the legacy businesses, which are run by family for generations and generations. I think the new folks who are taking over these businesses are much more amiable to sort of partner with us as private equity investors and then be a part of the process. I think that is one theme that we feel is playing out well and will eventually play out. I mean, a lot of these deals are also coming to us because of succession issues, right? The next generation doesn't want to be a part of the business, or they have some other aspirations. So I think this theme will sort of gain traction. In terms of the kinds of businesses, typically we would sort of look for a buyout. I think, I mean, as I mentioned, it has to be business first. So we really need to like the business. We cannot be backing an entrepreneur because as an investor, you're taking a majority position in the company, right? So it has to be a professionally run business. Otherwise, you're actually backing a founder or a promoter who's cashed out, right? So it doesn't work like this. At least in our view, businesses which are not very complex, right? And for which, let's say there are leaders who have sort of built businesses in the same space and now ready to take an entrepreneurial route, right? Whether it is in terms of, let's say, coming on board as the CEOs or the CFOs of the company. I mean, and we've done it eventually, right? In our portfolio company, we've got people who were working with KPIT Technologies to join us as the CEO there. People working in Wipro for 18 years coming to join us as CFO. I think eventually, I think what plays out is the entrepreneurial kick, right? They have built businesses in their previous organizations also, and they feel that there is an opportunity for them to be a part of an atmosphere where the hurdles are lesser, right? The processes are not so stringent that you cannot move and grow so quickly, I think. So, I mean, simple businesses, I think, makes more sense from a buyout standpoint.
Yeah, you're right. And, as data suggests, last financial year, 50% of capital, private capital, has been deployed in buyout transactions. So anybody else would like to, give their thoughts on which sector key trends do they see, which are, ripe for a mid-market buyout situation, be it platform or otherwise?
So it's interesting, 50% of deal activity is buyouts, and then 50% of that are buyouts that are less than 100 million. So it's very interesting that for all the noise around the large buyouts, actually, if you look at it, the number of deals, the activity is in the mid-market buyout space. Correct. And we, of course, big believers in that. In 20 years, like I said, 1/3 of our deals have been buyouts. We feel India is, in the next decade, will be one of the most attractive mid-market growth buyout opportunities. And these three keywords, we believe, I mean, at least we're betting our thesis on it, will be important, because if you look at, for instance, Japan, I mean, corporate divestitures is their buyout strategy, right? Or if you look at the US, in the days of cheap credit, LBOs was their version of buyouts. But India will continue to be a growth market, and our bet is that this combination of experienced enterprise protagonists looking to turn owners and not just employees is going to snowball into a meaningful trend. And we'd like to retain this 2/3, 1/3 ratio going ahead.
But what are the kind of motivations that you would see for a seller to sell the business? Is it succession issues where, the next rung doesn't want to do the business and the only option for the promoter? I mean, do you see family-owned businesses selling more and more buyout deals happening in family-owned scenarios? Or do you see, a first-generation founder scaling up, creating value, and then exiting?
Yeah, I think both varieties. So there's some very, especially in consumer, and if for this discussion, education and consumer, I'd combine into one. There's some very interesting assets that are, let's say, a few 100 crores in revenue, profitable, etc., where the second generation doesn't want to run it. The protagonist is in the 70s, and succession planning is the biggest motivator. And they want to leave this in a professional home, because they care about the employees and the legacy and what the brand has stood for. So that's a great opportunity for us. There are other flavors of this, which is corporates divesting, and I think far more rare are, let's say, other institutional investors then passing the baton on to other private equity firms. But in your previous question, where we were talking about distributed cap tables, that is also going to create some very interesting assets, where you have, let's say, the founder in a minority position, and everyone's hit their exit timelines and so on, but they want to sell to, the founder wants to either, stay on and give it a fresh lease of life, and they want a home, a professional home, that they are used to, as opposed to getting lost in a large strategic environment.
So highly fragmented cap table is not that bad. After all.
Not for us.
I mean, creates an opportunity for you. Okay, so I've saved the best for the last. Exit strategies. Let's talk DPI, right? Last 2 years have been, really good from a capital markets perspective, offer for sale, and being public markets being where they are, it has returned a lot of capital. Do you see this continuing in 2026, or do you see, what would be your preferred exit opportunities in days to come? Would it be secondaries? Would it be strategics? Or do you see capital markets will deliver what it has delivered in the last 2 years? Anyone. Actually, this is something that I would want to know from each one of you. So we can start with Gaurav, Sekhri, and we can...
See, if you look at valuations right now, where the markets are, right, maybe it's 22, 22 and a half, maybe 23. So the pricing and all is pretty good, in the sense it's a good opportunity. Whether it's going to stay like that for the next 2-3 years, I don't have a positive view on that, honestly. It should not, I think. At least when I'm underwriting, I'm obviously underwriting multiple. It's impossible to say for sure that you'll do an M&A in this time with this guy, even though I may write a note on that, right? Assuming this is going to happen. In my experience, the discovery has been very surprising on what actually happened on the M&A side. And no matter how hard I thought and how much I thought, right, it was somebody else. But what I'm able to figure out, who's not going to buy before I understand, that much you're able to figure out with quite a high degree of conviction. So at least when we are underwriting multiple ways to make sure that we are able to monetize the asset and the horizon that we want. I think rarely I've had M&A as my number one option. It's generally the preferred route is that if I'm able to list, that is probably most tax efficient, but subject to timing of that. And even if it is not perfect, it has still been better, at least from underwriting any other part for me. The other part, I think, it's a long-term growth opportunity where I think the secondaries are able to give pretty good opportunity to part exit, fully exit as well, like NBFCs.
They have
right?
done phenomenal. We've seen the number of pre-IPO rounds that we've seen where these secondaries have come in and,
Correct. Now we have
with the continuation fund kind of structures that are on these days.
Yeah, and I think now we have so many family offices also, right? Like Gaurav is there. So, and they are playing across stages. Of course, there are some stages there is much more comfort. And it typically starts, if you look at the revolution, it has been public equity investing, then it's pre-IPO. They are not everybody is not necessarily thinking very long-term compounding, like private equity is a 6-7 year hold for compounding to work. They're also thinking very differently about special situations. They're also thinking very openly about short-term IRRs. For some bets, obviously, long-term compounding that I can hold the asset forever. But of course, those assets are, at least typically when I'm seeing that company that you may discover once in a decade. Those are the companies they want to hold for 100 years. So, yeah, that's what I think.
Yeah, I'd just like to add that I believe there are only two credible exit options, at least in my experience. One is IPO, the second is secondary. We've never hung a hat on a strategic sale, at least from my experience. Within secondary, I think we get excited by the fact that there's a massive amount of capital at the late stage private equity ecosystem. So if you build a company at scale which is profitable and growing, you will get an exit. And valuation depends on the situation and the company profile in the market, but you will get an exit. So I believe there's a lot of, in fact, there are probably a dozen plus private equity professionals who invested in our fund, partly because they want to see what we're doing and for their own pipeline building. So there's clearly a lot of capital and they're under a lot of pressure to invest.
Kshitij?
So yeah, I think probably echo the same thoughts. Also, I think in terms of our secondaries, right, I think the management team and the founders also feel that there could be some level of continuation for them working with the new sort of investors. Otherwise, largely in a strategic sale, you'll see a lot of disruptions happening in 6 months to 1 year. So I think from a preferred point of view, obviously, I mean, nobody can bet on an M&A, right? But I think the way we underwrite our businesses essentially either getting acquired by a strategic player, and we try and build it to that extent. I think that's the first sort of step we take in a company when we invest. Obviously, secondaries with the kind of capitals being raised by the large buyout funds, India focus, not India focus, I think they'll be sort of able to grasp our growth capital investment. Obviously, IPOs are what they are. Hopefully, the market remains mind.
Yeah, we've exited companies through a variety of different routes. I mean, we've sold companies to KKR. It's Lighthouse Learning, used to be called Eurokids. That was the first buyout in education by KKR. We've sold companies through cross-border M&A. So we sold our stake in an Alcobev company called John Distilleries, which has a great whiskey, by the way. If any of you are whiskey people, you should try it. It's called Paul John. And we found a US partner called Sazerac, and that's been a great partnership. And then we've had 6 or 7 IPOs, in 20 years. And now secondaries has become a huge opportunity, and that's a great sign. So, when we look at investing, our underwriting, the most important thing is to keep your exit options open. And so even at the underwriting stage, we try and invest in companies that can be exited through any of the routes that I just described. And you keep your options open. We try to be disciplined about having an exit pipeline from day one, literally in the first 100 days of investing in a company.
to have a list of, who are the potential buyers of different types and how do you engage with that kind of ecosystem on an ongoing basis, educate them well before there is an exit conversation. And if there's one thing that we pray for in general, it's not lower valuations but liquid markets, right? Because that's good for everyone. You come in at a premium, but then you also have greater optionality for liquidity. And our own view is, no one can see the future, but we believe that there is a reasonable probability that India will be a $100 billion private equity market per year. And at that scale, you will be a private equity market of global scale. And that will require a full cycle kind of ecosystem from early stage to growth capital to buyouts to IPOs, etc. And that's when the virtuous cycle kicks in. And we are seeing already the early signs of that machine working. And that's what we pray for, that this machine keeps compounding, and we over the next decade we see the positive consequences of this virtuous cycle. Knock on the wood on the 100 billion. Clients are busy, music to my ears, right? Now, my first three colleagues here, they just mentioned M&A is not something that they would bet on in terms of exit. I just wanted to give you some data. After your public markets, M&A has been the second highest route to return capital. One of the examples which I can take in the public domain, minimalist. Like, wow, right? Your thoughts, Sumit, Chauhan, and then we wrap. Gaurav.
So, from our perspective anyways, we are also keeping a very long view whenever we are investing, per se. In general, we take like 4 to 5 years. It's fine if the company is growing. Anyways, post IPO, we can still hold. So we just keep as long as possible as the growth is happening in the business. Otherwise, we don't see anything if, we don't see next 4 or 5 years good, happening with a good growth in the business. Anyways, we look at protection plus as well as the growth. So ultimately 4 or 5 years on an average, but yes, if we can still hold post IPO, we will still go for that.
All right. Thank you so much, Gaurav, for your thoughts. And thank you, gentlemen, for this engaging session and sharing your rich experience with each one of us. Thank you so much.